The moment you feel that frantic, sickening urge to buy or sell, the market is running away from you and panic claws at your throat, that is the precise, crucial moment you must put your hands in your pockets and stand absolutely still. That feeling, that acute necessity to act now before the opportunity is lost, is the single most destructive emotion in speculation. It is the hallmark of the amateur, the symptom of terminal anxiety, and the guaranteed path to the poorhouse. You are not trading when you succumb to that urgency. You are not executing a plan. You are engaging in a desperate, futile attempt to catch a runaway train. I have seen men ruin themselves quicker with one impulsive, panicked purchase than with a dozen reasoned mistakes. Chasing entries is not merely bad execution. It is a profound failure of mental discipline. It guarantees instantly a trifecta of fatal flaws in your trade: poor position sizing, an impossible or illogical placement of your stop loss, and the swift, brutal liquidation of your mental and financial capital. If you find yourself stressed, sweating, constantly worrying about the positions you hold, it is because you did not let the profit opportunity present itself to you. You chased the price. You bought the feeling. And now the market demands its tax. Understand this central truth. Success in this business is not about intelligence. It is about patience. It is about control. It is about recognizing that the greatest danger to your capital is never the market itself, but the hot impatience burning within your own breast. You must extinguish that fire. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The principle of the waiting game. If I could distill the entire science of speculation into one observable, repeatable discipline, it would be this. Trading is 90% waiting, and perhaps 10%, at the very most, execution. The professional speculator is paid handsomely for his ability to sit still and do nothing. He is rewarded not for his action, but for his restraint. The biggest edge a speculator has against the eager public is not superior access to information, nor better charting methods, nor a deeper understanding of industrial factors. It is the absolute ability to sit on his hands for days, weeks, or months, conserving his powder until the setup is perfect. When you are waiting, truly waiting, you are accomplishing two profound things simultaneously. You are saving capital, you are not exposing your reserves to unnecessary risk, and you are saving energy. The market drains the impulsive trader. It extracts not only dollars but mental margin through constant worrying over marginal positions. The professional waits and watches, saving his nerve and his firepower for the moment of maximum conviction. Action, when it is driven by impulse, fear of missing something, or boredom, is the enemy of profit. If you feel compelled to act simply because the clock is running and the ticker is moving, you are no better than a gambler at the roulette wheel who insists on placing a bet every spin. The speculator's capital is his army. He must not march them into skirmishes. He must keep them bivouacked, rested, and provisioned, ready only for the great campaign. Action outside of premeditation is merely waste. Sit still. Wait. That quiet stillness is the most expensive yet most essential commodity in this business. Defining the optimal entry zone. Every successful transaction I have ever made was defined by the simple recognition of a specific price level that I determined in advance. This is what separates analysis from mere guessing. You must decide before the market ever touches that figure exactly what price you deserve for your entry. This price is derived from observation, a significant resistance line, the retest of a breakout, a value zone defined by major reversals, or a cluster of previous action. Any price movement that occurs outside of this predetermined optimal entry zone is, by definition, market noise. It is irrelevant static, designed only to confuse and tempt the weak trader. A chased entry means you have bought the noise, not the value. You have paid a premium for excitement. If you establish that you will buy a commodity only at $50, and the price runs from $51 to $53 without ever touching $50, the trade never existed. You must treat that hypothetical trade as if the market had never opened that day. The price must come to your level. You must never rush to meet the price. To chase a run-up means you concede your analytical edge. You state by your action that your desire to be in the move outweighs your discipline to secure the proper risk profile. That is a fundamental inversion of sound speculation. If the market does not grant you the price you set, the price justified by the technical facts, then the market simply did not offer a trade worth taking. There is always another commodity, always another day, always another move. Do not sacrifice the precision of your entry for the vanity of participation. The cost of the margin dollar. When a man chases an entry, he introduces stress to his position from the very first minute. Why? Because he is now holding a position that is structurally compromised. He has bought too high or sold too low. The position, 9 times out of 10, starts underwater. Even if it does not, it is dangerously close to the logical stop-loss placement, meaning the market has no room to breathe before it threatens liquidation. This immediately introduces a negative psychological stress, a toxic mental margin, that colors every decision thereafter. You become emotionally attached not to the profit you seek, but to the defense of a poorly initiated position. You waste energy defending poor ground. Allowing the price to come to you, hitting that optimal entry zone, means that your transaction is clean. Your risk is precisely defined, and the position starts with a structural advantage, meaning the price must move through the logical noise zone before it even threatens your break-even point. When your entry is based on structural value, the market can breathe, the stock can oscillate, and you remain calm, because your purchase was justified by the figures, not by emotion. An uncomfortable entry guarantees an uncomfortable trade. If you are forced to watch the ticker every minute, feeling that grinding tension in your stomach, it is because you paid the impatience tax. A comfortable trade, one that respects the structural advantage of a good entry, is often forgotten minutes after execution. It is the trade that requires no maintenance, only monitoring. Your aim is not simply to make money, but to make money easily. The difference between effortless profit and grinding anxious profit is usually measured by a single price tick, the one you chased unnecessarily. The stop-loss implication. The ultimate folly of chasing an entry is what it does to the very foundation of successful speculation. Risk management. When you rush in, you are already far removed from the logical starting point of the move. The logical stop-loss is always placed at the point where your original analysis is proven incorrect. For instance, if you buy expecting a breakout above $50, the logical place for your stop is perhaps back below $49, where the pattern structure fails. But if you panic buy at $53 because the move is running, where does the stop go? You now have 2 terrible choices, both of which guarantee failure. First, you can place the stop where it logically belongs, back at $49. This makes your distance to the stop $4, which is double or triple the intended risk, meaning your position size must be cut dramatically, ruining the potential reward ratio. You are risking too much to secure the correct stop placement. Second, you panic and tighten the stop arbitrarily to perhaps $52 or $51, just to keep the position size adequate. This tighter stop is now purely arbitrary. It is placed within the normal fluctuation and noise of the market. You will be liquidated by market noise, only to watch the stock turn and continue its advance without you. A poor entry makes rational risk management utterly impossible. The disciplined entry ensures that the stop is placed exactly where the analysis fails, providing the necessary distance for the trade to breathe, while keeping the absolute monetary risk manageable. The moment you chase, you are committing arbitrary risk. Arbitrary risk guarantees arbitrary loss. There is no recovery from that position. The market respects those who define their risk before they define their position. If you chase, you have reversed the order, and you have failed before the broker has even filled the order. Found the big play versus constant action. I have often stated that my fortune was not made by constant frenetic activity, but by sitting patiently and waiting for the undeniable massive moves, the big swings that defined the trend of an entire group of stocks or a whole commodity for months. The biggest mistake of the perpetual trader is his addiction to action. He feels he must capture every minor swing, every petty fluctuation. But these minor swings deplete three things: capital, emotional reserve, and bandwidth. Capital is drained through cumulative commissions and petty losses on entries that lacked structural conviction. Emotional reserve is exhausted by the constant worry and necessity of monitoring marginal positions. Bandwidth is consumed by managing a dozen mediocre trades instead of focusing on the one monumental trade that could truly change the ledger. Chasing minor entries ensures you are broke, or worse, emotionally hesitant and gun-shy, when the real career-defining opportunity finally manifests. The market exists 250 days a year. The opportunities worth taking, the movements that offer genuine low-risk, high-reward prospects, those movements happen maybe a dozen times, 12 times a year. Your task is to conserve your ammunition for those 12 battles. The moment you chase a marginal movement, you are sacrificing future opportunity. You are burning powder on crows when you should be saving it for elephants. The capital you preserve by sitting out 50 noisy, tempting moves is the capital that allows you to take the full, correct position size when the market finally confirms the major trend. A professional's patience is his strategic reserve. Do not waste it on minor skirmishes driven by boredom or the fear of being left out of a small gain. The anxiety and resulting losses that come from aggressively pursuing entries constitute the market's most expensive experience charge. Edwin Lefebvre recognized this principle in 1923, meticulously documenting the often brutal education and hard-won strategies of Jesse Livermore, the great speculator often veiled as Larry Livingston, within Reminiscences of a Stock Operator. Reading this narrative is akin to engaging in a concentrated training ground for the mind, allowing you to absorb decades of high-stakes market knowledge without incurring a dollar of actual risk. To ensure this profound wisdom translates effectively across market epochs, we specifically recommend the Max Davidson edition. His contemporary annotations and commentary bridge the gap between Livermore's early 20th century vernacular and today's complex trading environment, making it the essential curriculum for any operator serious about avoiding unnecessary market penalties. A link to this foundational edition is provided in the description below. The act of chasing is fundamentally an act of prediction. The amateur sees the price move sharply and thinks, "It is running. I predict it will run further. I must buy immediately to secure my spot." He is anticipating the future based on the enthusiasm of the present. This is speculation based on hope. The act of letting the price come to you is fundamentally an act of confirmation. The professional identifies the level, say a strong resistance at $100. He waits. He does not buy as it approaches. He waits for it to hit $100. He waits for the market to test that line. And then he waits for the market to prove its intent. He waits until the price hits his zone, and then he looks for the confirmation. A rejection candle, a sudden surge of volume indicating absorption, or a clear reversal signal that proves the original analysis holds true. If you are waiting for confirmation, you are entering the market on evidence. If you are chasing, you are entering on rumor. I do not wish to predict the future. I only wish to confirm the present at the most advantageous point. If the market runs away from your predetermined entry, you must allow it to go. Perhaps it will fail at a higher level and return. Perhaps it will run to the moon. Neither outcome matters to your balance sheet because you had no confirmation at your entry point. If you chase, you are buying the market's enthusiasm. If you wait, you are buying the market's structural weakness or strength, confirmed at a price point you already deemed important. Always wait for confirmation on your terms, not anticipation on the market's terms. The market's terms are designed to relieve you of your money. Your terms are designed to secure it. The psychological penalty of impatience. The speculator must understand that every impulsive, unsuccessful action exacts a toll far greater than the monetary loss. It extracts a psychological penalty. Every time a trader chases a price, gets burned, and suffers a liquidation, he pays an emotional tax. This tax manifests as hesitation, fear, and crippling doubt when the next high-probability, perfectly structured setup finally appears. The experience of chasing breeds the memory of failure. When the market finally gives you the perfect entry, the stock hits your ideal price, shows the confirmation signal, everything is textbook. The memory of the previous panic entry that liquidated you will whisper doubt in your ear. This is going to run away from you again, just like last time. The defensive trader, the one who operates by allowing the price to come to him, builds confidence with every successful stress-free execution. He knows his system works because he respects its boundaries. The moment you enter a trade based on anxiety, you sacrifice your internal peace. You trade the next week with damaged nerve. You trade small, or you hesitate, or you miss the next great move entirely because your previous mistake made you gun-shy. Your trading stress is a direct, observable measure of your internal impatience. If you are stressed, you are forcing the trade. You are pressing the issue. The market has a marvelous way of rewarding the calm and punishing the frantic. The ultimate psychological strength of the great speculator is his profound belief that if he misses this specific move, another one, just as good or better, will appear shortly thereafter. The desperate speculator believes this is the last train leaving the station. This difference in perspective, this deep psychological patience, is worth millions. It preserves your capital, monetary and mental, for the moments that truly matter. The market's indifference to your schedule. You must internalize this truth. The market is entirely, profoundly indifferent to your needs. It does not care that you missed the move yesterday. It does not care that you need action today to satisfy your brokerage requirements or your own sense of self-worth. The market moves when it moves, and the market rests when it rests. Successful speculation demands the complete decoupling of your personal, emotional, or financial needs for activity from the market's timing. If the proper setup, the clean entry zone, the confirmation signal, the risk profile is not present, then there is no work to be done. Too many traders confuse activity with productivity. They believe their job is to be constantly engaged with the ticker tape. The professional's job is to secure profit. If securing profit requires sitting still for 3 weeks while the market chops sideways, then that is the job. If you find yourself forcing trades because you feel compelled to justify your presence at the desk, you are turning a highly intellectual enterprise into a labor-intensive, low-return grind. The moment you chase, you are sacrificing precision for speed. You are saying, I need to be in this position 5 minutes faster than my analytical plan dictated. That 5-minute advantage you seek will cost you the structural integrity of your position and ultimately far more than 5 minutes of profit. If you are not certain, do not act. If the price is not right, do not act. If the confirmation is not absolute, do not act. The market will wait. You must learn to wait with it. Never assume the market owes you an entry today. It owes you nothing. You must earn your entry by demonstrating discipline. The practice of premeditation. The true speculator does his most vital work before the opening bell rings. The great speculator, when he approaches his trading day, has already defined everything. He has drawn his lines in the sand. He has marked the levels he will buy, the levels he will sell, the exact tick where his analysis will be proven false, and the target where he will realize his profit. This is the practice of premeditation, and it is the only reliable defense against the impulse to chase. When you have a fully articulated plan, any price action that occurs before the market reaches your designated entry price is instantly designated as irrelevant. It is noise, it is temptation. It is movement designed specifically to hijack the weak emotional trader. If the stock is trading at $45 and your entry is $42, then the movement from $45 to $44.50 and then up to $46, that movement is absolutely none of your concern. It does not exist for you. When you chase, you permit impulse to override premeditation. You allow the present excitement of the market to erase the cold, hard logic you applied during your preparation. The plan must be so clear, so precise, that when the moment of execution arrives, emotional impulse has no ground upon which to stand. If you see a stock running up wildly, you must be able to state, "My plan dictates I buy only on a retest of X dollars. It is currently at Y dollars. Therefore, I have no trade." This detachment is not apathy. It is the highest form of professional discipline. If your plan cannot restrain your hand during excitement, then your plan is worthless, and you are merely operating a bucket shop for your own account. Draw your lines. Define the irrelevant. Protect your plan from your own anxiety, using time as your ally. In speculation, time is not merely a measure of patience, it is the ultimate filter for low-quality moves. The act of chasing fundamentally ignores the critical role of time in validating a price level. Consider a significant resistance zone. A price that approaches this zone quickly, a furious vertical dash on low relative volume, and then pulls back quickly is often nothing more than manipulative noise or a short squeeze that lacks conviction. If you chase that move, you buy the noise and suffer the inevitable snapback correction. A true high-confidence entry often requires time to develop at the critical level. A price that approaches a resistance zone, tests it, consolidates sideways beneath it, perhaps tests it again, and then slowly, over hours or days, either rejects the level or accepts it. That process provides high-confidence entry signals. Time allows the market to prove the validity of a level. If the market struggles at a price, spending hours building a base before a break, that base confirms the intent of the large operators. If the market dashes to a price and immediately recoils, that tells you the move was predicated on temporary excitement. You must allow time to validate the setup. If you chase the initial momentum, you are betting on speed. If you wait for the consolidation and the retest, you are betting on structural strength, which is exponentially more reliable. Do not be afraid of a move taking too long. Be afraid of a move that happens too fast. Time does not merely heal the wounds of poor decisions. It is the essential element that validates high-quality trading setups. Use time as your critical lens. Wait for the story to be fully told at your price point before committing your capital. Jesse Livermore taught that the critical difference between the amateur speculator and the professional is not intelligence or charting ability, but profound bedrock patience. Stop begging the market for an entry. Stop trying to force a position where none exists. Your task is not to find a way into every movement, but to find the 1 or 2 movements a month that offer the cleanest possible structural advantage. Draw your line in the sand. Define the price you must have. Sit on your hands and allow the market in its own good time to deliver the profit opportunity directly to your desk. That discomfort you feel while waiting, that gnawing tension, the fear that you are missing out on riches, that discomfort is not inefficiency. That is the feeling of professional discipline at work. You are being paid to wait. The mastery of speculation is not found in the furious action of the tape, but in the deliberate, calculated stillness of the man who controls his impulse. Be still, be disciplined, and the market will eventually come to you. You are filling yourself with knowledge, which is excellent. But knowledge alone won't make everyone rich, because not everyone possesses the right foundation. The market is the same for everyone. The only difference lies in the mindset. You can have a perfect trading system, but if you lack discipline and an understanding of your own psychology, that system is worth nothing. I often see a recurring theme in your comments. It is easy to talk about strategy in theory, but when it comes to the actual trade, many struggle with emotions. For those who want to focus on discipline, patience, and self-discovery within trading, I've created a new channel called The Stoic Trader. I believe it will help many of you bridge these gaps. So, if you think this kind of content would be useful to you, go ahead and check it out. The link is, as always, in the description below.